Better Dwelling is one of my favorite sites for real estate news. The layout is clean, the color scheme is great, and the analysis is good too. So it's just a great combination of things. That's not to say any of the other sites that I go to for news is not good. It's just, you know, you have your favorites, and this is one of mine. So Canadian mortgage approvals for over-leveraged borrowers soars to a record height, or record high. Anyways, Canada's banking regulator is seeing a spike in highly indebted mortgage borrowers. The Office of the Superintendent of Financial Institutions, or OSFI, observed renewed growth in the exposure of mortgages to over-leveraged households in Q4 2020. Low interest rates are fueling rapid growth in borrowing for both quantity and size. The share of mortgages going to over-leveraged borrowers blew past the pre-B20 highs. It now sits at the highest share of originations on record. So, what we might be seeing because of this in the future is additional regulations when there's a fear um, that people might be putting themselves into a negative situation. Uh, our government likes to step in, especially when it comes to the housing sector. Or the real estate market, right? So that's probably something we're going to see, some sort of policy put into place maybe over the next year, depending on how the market goes. But if reports like this continue to come out, then it's going to add some, ammunition to the argument that they need to clamp down on the market. Now, I personally think there is something that can be done, but I think it's on the supply side. If we have more housing that's being built, I don't think people will feel the need to push themselves to the edge just to have a decent home, right? So just to have a place with some space, a backyard, and within a reasonable distance to their work, right? So if we kind of create a situation where people are able to have those things, and if we have policy around that, then I think that would probably be in the long term better. But that's not how things work here. So we just like to tinker around the edges, right? So how much is over leverage? So OSFI uses the loan to income ratio to determine segments of indebtedness. If a borrower has a mortgage LTI of 450% or more, they're highly indebted or over leveraged. This means their mortgage that is at least 4.5 times the borrower's income. Ideally, the ratio of these borrowers falls, lowering risk. When this ratio arises, risk increases, setting off regulatory radars. High levels often precede overly easy lending, which can become a problem. When regulators call it out, it often precedes new regulations to lower it. Yeah, exactly. It often precedes new regulations to lower debt, like it did in 2017. That's exactly it. I mean, they don't start rattling. I guess you call it rattling sabers. They don't start making noise about these things prior to. I mean, almost always they start making noise prior to trying to make some sort of policy change. So, Canadian uninsured mortgage originations to highly indebted borrowers. I think the interesting thing here is there is a qualification process that they still have to do. If you're going through for a conventional or uninsured mortgage, you still have to qualify depending on the lender. Now, if you're getting a private loan, like or through a mortgage investment corporation, or just a private individual or group of wealthy individuals, then you don't necessarily have the same qualification standards. You'll need a down payment, but you won't have to qualify based on income. And that's obviously an issue. I mean, there's a lot of issues around that. But when it comes to like a B lender, like there's a number of them. I won't name any one specific. But when it comes to what they call a B lender or so like a non-bank lender that they're not what a lender that does isn't as rigorous when it comes to the income requirements, or when it comes to the credit requirements. They kind of take a more general common sense view, if you will, at a file, at an application, and they'll make a determination if the risk makes sense for the overall portfolio. And because of that, there's typically a fee involved in higher interest rates, but they still have some sort of qualification standard. And it's not like they're just handing out money to people that can't afford the mortgage, especially if it's not insured, because there's a lot more risk to the institution that's lending out the money than if than not, right? Than if they were having the mortgage package up and insured. So I don't know if to what degree this is bad news, but it does mean that there will most likely be changes to policy in the future. So that's something to keep in mind. So yeah, so if this sounds foreign to you, B20 guidelines are what created the uninsured stress test, which everybody has to, if you want to, well, basically you have to go through that if you're going through an OSFI regulated bank, which required banks to test borrowers for the ability to pay bills at higher interest rates. Almost immediately after rolling out the guidelines, highly indebted borrowers dropped off dramatically. Exactly, because I mean that means you're not qualifying based on the contract rate, and the contract rate is the interest rate that you would be paying on the mortgage at the time of application. Your your qualification, your ability to receive the money is based on a much higher rate. In case the interest rates jump, and we just want to make sure that you can afford your mortgage if the interest rates were to jump. That's really it. And whether it's the best way about going about it, that's the way we do it now. So cheap credit from the pandemic accelerated the growth trend, though, pushing it past the previous level of concern. Complicating the issue further is the fact mortgage volumes today are also likely much higher than they were a few years ago. So on a positive note, or less negative, the debt servicing of these borrowers improved. Over-leveraged borrowers had an average total debt service ratio (TDS) of 43.57% in Q4 2020. This is down from the recent peak average. I mean, slightly down. I mean, to what degree does that reduce risk is a question. Historically, low rates are behind the trend, likely making it temporary. When rates rise again, servicing costs are likely to push higher as well. There was also a string of debt consolidations as well. So, if they're taking in total debt into if it's a TDS calculation, there's a lot of debts being written off, and also debts being consolidated as well. So I'm not sure to what in late 2019 and throughout 2020. So I'm not sure to what degree that has impacted the total debt servicing. But yeah, so that's really it. I mean, we're most likely gonna see some policy changes coming up when they, I don't know, when they start to convene, or when they start to have the discussions. Most likely that we're going to start hearing more and more rumblings about we need to do something about the overheating real estate market. I mean, this would have been great if they had a conversation, prior to something happening, as you see it about to happen. But we don't really do that. We have a reactive system, right? So after it happens, we then figure out what we can do to stop it from either continuing to happen or happening again, and usually to no avail. So, yeah. So let's see what they come up with, what they think is going to solve the issue of this indebtedness, because it's really what it is people are buying more and more expensive homes, and because of that, they have to have larger mortgages. So more homes helps to lower the price, but if we're not increasing the supply of homes, and we're constantly increasing the amount of people buying these homes without increasing the supply, well, we're going to see increased debt loads continuously, right? But that's anyways, that's just my thoughts on that. Let me know what your thoughts are. Uh, Yeah, do you think we are just going to continue to see an increased leveraging of Canadians until maybe we hit the wall? Because obviously this isn't a good trend to see. This is going to dampen any other consumer spending if we're going to see a continued increase of the Canadians' money going towards debt servicing, right? I mean, if you're paying your debts, and your interest rates keep going up and you're paying your debts, you're not really going to have money to spend on anything else. How are you going to save money to also invest for, you know, uh, invest in a new business or do a lot of these other things, right? Your money's going to be trapped in servicing debt. So what will happen is the question. So let me know what your thoughts are. And feel free to like, share, and subscribe if you like any of this content. All right, have a great one.